look at our meeting notes for today. All right, so looking at seasonality is pretty important. December, October, November, December are the best months of the year, usually seasonality-wise. It doesn't necessarily have to be that way. A couple of years ago, we had a really bad December. It went down like 10% or more. And but 90% of Decembers end up being positive for the month. So that's why we try to map this out, and to try to make everyone have good expectations or expect what's going to happen next. Right now, we're actually super overbought in the stock market. Let's look at the stochastics. This is the S&P. I think 80% of all stock movement tracks the S&P 500. So if we have S&P going up, there's a good chance the other stocks in the stock market will follow. Okay, so let's go. Okay, so right now we've been overbought. Look at this. This is probably the most we've ever been overbought for a long time. That's probably because we've had some good news for the treasuries. They've been going down. And currently we have a 1-to-1 correlation to treasuries going down, stock market going up, and vice versa. So you can see since last week, we've had interest rates go down. And as interest rates go down, the stock market goes up. And that correlation won't last forever. It just happens to work right now. And a lot of people on TV are commenting on that. All right, so let's look at some of our big picture things. What's happening? We're overbought. So there's a good chance in the next week or so, we're going to be going down. I'm not sure why that's... Okay, I'm not too sure. Yeah, so right now we have a Fed meeting on the 13th of this month. So that's next week. So a lot of people are cautious around that. So I'm expecting the stock market to go down in the next week or so. So this is just so that you can time your investments if you're buying or selling. So right now we also have triple witching, it's called, on the 15th. That is expiration of contracts for options. That happens a couple times a year, and when it does, you have volatility. So if it goes up and down a lot that day, don't make too much of it. And I marked the rest of from the 19th to the rest of the year as good days, because that's what Mark just said, the Santa rally. Actually, officially, the Santa rally starts Christmas and goes towards the end of the year. And there's a lot of repositioning for index funds and things like that. So, so if we look at our S&P chart, there's a very good chance we can go dip down a little bit in the next week or two and then go up towards the end of the year. For me, I'm not buying or selling. I'm just holding, but I'm just managing my expectations and kind of doing these charts just to keep my sanity. All right, and we have Christmas and we have New Year's coming up. So those are two big holidays people get excited about, and they have happy feelings. A lot of times happy feelings in holidays translate to happy feelings in the stock market. All right, so we have a couple things that happened this week. We had payroll reports today, and they were very strong. So what we're doing on our map right here is we're kind of mapping out when there could be a recession, if there is one at all. When there's strong, I think on Yahoo Finance, do we have Yahoo Finance? I'm not getting the internet today for some reason. Okay, so so there was a strong payroll report. That means the chances of recession near term are pretty low, because you got to have huge job losses, you got to have firings, and you got to have people without money that can't spend, and that could happen maybe in February or March. I'm not sure, but the chances for me as a long-term investor, this could happen, but we'll have a couple of quarters of down, no sales, but it'll pick up after 5 months or so. So we'll probably recover from a recession right here in July or so, if there is one. So I don't think it is that big of a deal. But this strong jobs report that happened today has a very good indication that the economy is strong and you don't have to worry about a downturn near term. So I erased the January recession. I moved it a little bit till February. Now the other things we have to think about are, you see, we had the treasuries go down this week. So usually when the treasuries go down, the stock market goes up. That didn't happen. The stocks are unchanged. So basically we're still in a position where, if you look at our stochastics, we're starting to go down. You see that right there? That is an indication we're going from overbought to oversold. We just started the transition to going down to oversold. And that could happen like a week or two. And this could stay elevated for a long time. I don't know. But for me, buying and selling stocks, it's always been better to buy when people are selling, like at the bottom here of the channel, and right here when it's oversold. And when it's up to here, that's like the time you don't want to buy. All right, so let's look at some more things we're following. Okay, we have, you see, still the seasonally best time of the year. These are all good indications we're in a uptrend. We have 81% of the S&P above the 50-day moving average, and it's 61% above the 200-day moving average. That is indications of momentum. So whenever you look at momentum and you look at this chart, this is whenever you have an uptrending stock market, that's like momentum. And whenever you have a situation, I'm not sure why it's blacking out like that. I'm sorry about that. It must be my computer memory or something. Okay, so we have to wait for this. Okay, so we're in a super overbought state right now. That's from this run in the stock market we've had. Okay, not sure why it's going like that. We close down a couple of windows just so we can have some free space. Okay. Right, so let's look at some of what we had to talk about today. Okay, so this inverse correlation is still working as the stock. This S&P is the purple, and the treasuries are the other chart, and you see they're going diverging. So we're pretty much not in control of that right now. And let's look at some of the major variables in the stock market. The price of oil, this is really big. It's down to $70 a barrel. That's an indication that there's either one of two things: a decrease in production, which doesn't seem like that. Increase in production doesn't seem like that, or a lack of demand in the world. So we could be going into a global recession. I'm not sure. Or we could have like a U.S. increasing their production. We don't know which of those it is, but usually when oil goes down, that's an indication of a very weak economic environment. So that adds credence to our idea that there could be a recession coming. Okay, so the other thing is the dollar is not changing, so and gold is pretty much unchanged too. So let's look at the fear greed index. We're still greedy. We're less greedy than last week. So we're going from greed, and maybe in the next week or two, we'll get to the fear. We were at 67 last week, so it's 67, 64. Now we're starting to go back to the fearful side. It's not the time to buy. That's what that means. I added one more thing to this talk, the AAII sentiment results. And what this is it's a contrary indicator where the stock market's going to go. So typical investor thinks if the stock market's going up, they should be bullish. And if the stock market is going down, they should be bearish. And you should actually think the opposite of this. So right now people are in this AAII survey. They think it's the stock market's going to do really good. So you got to think the opposite. and that corresponds with our other charts that says we're overbought. So we look at some of the times that we had this overbought, and it corresponds to market tops. And whenever you look at the times when we were max bearishness, right here in November, that was the time to buy. So we're going to keep track of this. When it gets back down to 24, that's the time to buy. And whenever the bearishness gets up to 50, that's the time to buy. So we'll keep an eye on that. This is America. It's individual investors, that's small investors, and they get into groups and they have these surveys. So that's what that's about. So the dollar is going down. It's in a downtrend. That's good for the stock market. So this is 1%, addition to the stock market going up. If you have the dollar going down, that's really good for the stock market. I'm not sure how good it is for our spending. The dollar goes down, and we can't. The value of our dollar is less. That's not so good. But the VIX is actually down to a point where it's people aren't afraid anymore. So this is another contrary indicator. It's a bull market, so people are pretty excited. We are in an uptrend, and we do have good people on the internet and on the news. They say, "Well, we're in another bull market. Everything's going great. It's the end of the year Christmas rally. We're right here in our paradigm," and that's usually not the time to buy. The time to buy is when people are afraid, fearful, and desperate. I kept track of these issues that could cause a crash. We have a lot of major issues. One thing that came up in the news today, consumer debt is becoming a huge problem, and that could cause bankruptcies. A new warning came out this week. That's becoming the biggest problem in America for the stock market. If there's a problem where people borrow too much and they won't be able to spend as much, and that could make the economy go into a recession. There's a lot of smart people are saying about that. So I think this is the biggest risk for a stock market crash or a recession or the stock market to go down. We also have overpriced, stocks like the big 7 tech stocks. They're still being bid up, but like people are satisfied with paying high premiums for those stocks. Our gas prices are getting better, so that's kind of helping out the stock market because people have more to spend in the economy. And AI is dominating the news every day. So we haven't had a bubble bursting there, but there's a lot of high valuations in that area. All right, so let's look at some more things. We know that right now the PE ratio of the S&P 500 is 20. And around this interest rate, it's usually 15. That's a 20% correction. So at any point in time, we could correct 20% and things will go back to normal, which is this middle line here. This 14 PE for the stock market. It's generic. Stocks change over time, but on the average, 15 PE or 14 PE is the average. So eventually we'll go back there. Right now we're at 20. So, okay, so we had some news today with a very strong labor market. I can't pull up the article because my internet isn't working for some reason. But there was a good jobs report. That means the Fed has to hold interest rates higher for longer because the economy is doing really good right now. So so on our calendar, we moved the interest rate cutting. Let's look at our calendar. Interest rate cuts. I moved that to maybe May. And whenever you have interest rate cuts, that helps the mortgage demand and selling houses and things like that. So we have to move that out to there based on this story. And we moved the recession to a month later. Okay, so let's look at, so what other things happen with this report? So the labor market is turning out to be really good. So that means the Fed might raise interest rates or keep them higher for longer, just so that the economy cools off. And that's not good for the stock market. That could be a reason for the stock market to correct today. If I can't check on it because I don't have access to the internet. For some reason, my internet isn't working. I'll try one more time with a different browser. Okay. This is that article that came out. A veteran economist just echoed Elon Musk, Michael Burry's warning that Americans are drowning in credit card debt. So there are higher interest rates are causing problems with buying cars, buying houses, buying, and inflation is causing these problems. So this is a big picture thing you got to know when you're investing, that this affects the economy, and all companies will do worse when there's a slowdown. So you got to prepare for a recession, perhaps in February or March. I'm not sure. So let me see. So we can get the internet. No, can't get the internet yet. Okay. There's an Apple article about Apple making more of their phones in India. One of the biggest problems with Apple is there's geopolitical problems in China. If there's a tit for tat, we can't sell them things like chips. And if Apple is caught into that somehow where they can't manufacture and China sets some rules, then they can't make their iPhones, and that's a major problem. So what they're doing is they're shifting 1/4 of their iPhone production to India, and that's growing every year. So that alleviates some problems in case, let's say, China attacks Taiwan or something. So that's very important for Apple to diversify away from China. And the only thing that can stop Apple right now is some kind of government regulations or some kind of rules that China sets on their manufacturing or something like that. I'm not sure. But this is one of my biggest holdings, so I'm always super concerned about how they're going to continue going forward and if they're diversified enough to handle any situation. But whenever you're invested in a company as a long-term investor, you got to think about these things. Every little article that comes out, you got to say, does this affect my initial investing thesis? My thesis when I bought Apple in 2010 was I believed in the iPhone 6 at the time. I'm like, this is the greatest thing, and I think it's going to sell a lot. And at that time, that was my thesis, but over time, it's evolved from iPhone 6 selling great to having this ecosystem that people are stuck in. They got to keep buying their iPhones and keep paying for services. And it's a kind of a robust business model, which is really good. And this is kind of making their manufacturing more robust. So, as I hold the stock, I have to keep researching. I'm allaying my concerns about manufacturing, about their future, with reasons why I don't have to be worried about that. All right, that's very interesting. AMD is starting to make AI chips, and they see the AI chip market as a 400 billion market, and that grew like 3 times from earlier this year in their estimation. So, so what they're saying is this AI chip market is bigger than initially thought, and that's really good for all the other players in this industry, which is the biggest ones are NVIDIA, AMD, and Intel. And there are some other people involved in this, like Broadcom, that I'm not sure exactly how Broadcom's involved, but this is becoming like the most glorified, new technology that could be the next internet, as people say. We don't know how much it's going to be, but right now NVIDIA has been the one that has went up the most, and all these other companies are kind of starting to go up in anticipation of this AI being in every data center in the world. Okay, let's look at, there's an article about Broadcom. This is an example of the stock that has an AI kicker, it's called. It's actually semi-involved in AI, making chips, but they also have all these diversified parts of their business, which is interesting. They initially were a chip company only like 5 years ago, but they're starting to diversify into software and services. And software and services have a bigger margin, which is how much money they make. Like if you make a handset for $100 and you sell it for $200, that's a big profit you make there. And whenever you have software, you basically don't pay anything for the software, and you take a lot of profit from that. And they're doing, they bought VMware, which is mostly services. So what they're doing is they're gradually going from chip making to services. And so they had a mixed earnings report. So this VMware is going to be one of their biggest services they provide, and they are forecasting double-digit growth in the business. And you see, they're also a solid artificial intelligence play, and they have these hyperscalers. I'm not sure exactly what that is, deploying internet into their AI networks. So even though they're not a direct competitor to these other companies, NVIDIA, AMD, and Intel, they are involved in this AI. So they get a premium. You pay a premium for being in that genre. Okay, so it's interesting what they're involved in. They're involved in infrastructure, which generates 42% of their revenues, and 20% is from selling to Apple for their iPhones. So they're involved with making some of the parts for the iPhones. And that's really reliable because they just renewed their contract. So you have reliability there. You have reliability with recurring revenue with the VMware software, selling software. And so what I thought it'd be interesting to go through the statistics for this company now. And this is from Yahoo Finance. This is explains most of the things we're looking for. One is the total debt is 1/10. It's like 30 billion. If you subtract out the cash, that's less than 1/10 of their market cap. That's okay. But if it gets really close to their market cap, then that's a major red flag issue. And right now the forward PE is 20. That's not bad either. The PEG ratio is 1.47 according to Yahoo Finance, and the profit margin is awesome, and the return on equity is awesome too. So that passes all of our initial screens. So that's really good. Let's look at their earnings estimates. This is from E-Trade. I got this from E-Trade. You can see that one of the greatest things about this company is you have this solid earnings growth in a straight line up. It's really hard to find a company that doesn't have like a negative quarter or something like that. And so that's a really good thing. And if I looked at the year's estimates going forward, and I saw they're only growing around, next year it's 18%, then it was 10%. So it's around 16% if you average all these together. And the PEG ratio is around 1.2, according to my calculations, if it's grown at 16%. And they have a 2% dividend. So they're growing at 16, maybe with the dividend, that's an 18 total return. And you got to have an investing thesis if you're really interested in this company. You have to have an investing thesis. And right now, they're getting into AI. I'm not sure exactly how, but it's somehow associated with their networks that they deliver. They have strong customers such as Apple, the 20% of sales. And they just renewed their contract, which is good. And they own VMware, and that's very high margins. And they're profitable, and they're trying to diversify from semiconductors to software. That's a thesis for this company. And you can see that they have a really good track record also of acquisitions. So if this VMware turns out really good, that could allow their margins to expand. So here, what I did was I looked at the Morningstar comments on this. They always give, good bullet points of why the good and bad parts of the company. They said it's around fairly valued, like maybe 5% undervalued. They have let me see. They said they have a higher long-term forecast for artificial intelligence-driven chip sales. More bullish assumptions for the integration of VMware. They haven't really gone up like all the other AI companies. So okay, so they have stellar profit margins, and they have a very impressive acquisition program. So these are all the theses that we laid out, and Morningstar kind of said the same thing. They see the shares as modestly undervalued. Okay, so what I'm going to do now is I'm going to look at CFRA. They're a little better analysts there, I think. They said they're overvalued by 20%. That kind of matches what we were looking at. So they're, what I like to look at on this CFRA report is their summary. They have a little summary area. It says it would be a major winner from AI infrastructure boom, driven by its networking switcher AEC business, as well as potential cost synergies from the VMware deal. Okay. And Apple, they extended their chip supply agreement with Apple, and they're growing their software exposure 40 or 50% of sales. So that is good. If they can grow this more every year, that'll make this return on equity go up. You can see that this is going up in a straight line. That's very important. So it was 10, 12, 27, 48. So 48 return on equity is really good. And you can see the revenue is going up too. You see it's any growth stock that you want to look at, you have to see it growing in their revenue and earnings. So these are all good signs, but they're overvalued right now. I think if we look at our valuation metrics, it's maybe 20% overvalued. So this is a good example of a stock that'll correct a lot when there's a market correction, and then you can go and look at it and buy it less expensive. But anyway, I thought that was interesting to go through that little exercise with the example of a stock that could be hyped up with the AI news stories these days. Okay, let's look at this is an article from Jim Cramer. He said this industrial giant can benefit from a big data center project, and he talked about this company called Eaton. They make data centers, and that's what they're specializing in. They're like an infrastructure company, like GE or one of those companies. But there's a potential big project by Blackstone and Digital Reality to make a data infrastructure in Europe, and they could be a benefit from that. That was a news story. So Jim Cramer said it's time to start looking to buy this. So I'm going to look at the statistics for this company, Eaton. I guess you can call them an industrial company. They make electrical infrastructure projects for big data centers and things like that. I looked at their earnings estimates going over the next couple of years. It seems like they're growing about 10% if you average them all out. And their PE is 21 right now. So the PEG ratio is 2.1. So they're 2.1 times overvalued. But Morningstar says they're about 10% overvalued. So it seems like Morningstar has they have different information for me. Let's look at their statistics. Their profit margin is good, 13. That's our minimum. Return on equity is decent. That's 17. That's near our minimum. And the enterprise value is 100 billion. So that's kind of a big company. So PEG ratio according to Yahoo Finance is 2. That kind of matched our numbers too. So I guess you pay a premium for a stock that's consistently growing like this in a straight line. So that's pretty decent. I would look at this, and I'd say when it gets a PEG ratio 1, I would want to buy it because that's reliable growth, but it's really not growing a whole lot. It's going to like maybe 10%. Whenever it gets half the valuation it is now, then I'd be interested in looking at it. Okay, so now let's look at what, let's see. Okay, yeah. So I looked at that. The total debt for the company isn't that bad. It's their total market cap is 100. Total debt is around 6 billion. So 6 billion out of 100 isn't that much. And besides, a lot of the biggest companies have financed their debt at like 1% interest. So a lot of times, if you see a lot of debt on the bigger companies' balance sheets, it's not necessarily as bad as it looks. But they have a 1.5% dividend too, which isn't bad. All right, so for me, I'd wait for this to go down to a peg ratio 1 before I'd buy it. Let's see if I can get to the internet yet. Come on, give me the internet. I'm not sure why I can't get the internet. This will be worth it. I'm going to try to close. I'm going to try to terminate this. This Firefox. I'm going to try to terminate this so I can get on the internet. It'll be worth it to get on the internet. Okay, let's try it one more time. Oh, nice. We finally got it to the internet. That's awesome. Problem is we're on Edge, and Edge doesn't work with any website. I'm getting there. I'm trying to get on the internet here. All right, that doesn't work. We have to go back to our notes. All right, so Eaton, you can see Eaton, Jim Cramer's newest stock. I don't know how consistent that is at all. It's not very consistent. It's earnings, and its revenue not going up in a straight line consistently. I mean, it's pretty much all over the place. So these are consistently probably around 13%, which isn't bad. But this is kind of unreliable. In Facebook and Google, you see this going up in a straight line. For this company, it's kind of flat revenue, flat earnings. No, it's pretty unreliable. For me, I wouldn't be interested in this company. Jim Cramer likes it. We'll keep our eyes on it. Maybe if it goes down in half, we'll revisit it then. All right, so look and see if we can get on the internet again. Right, what's going on here? Okay. Well, it's a good time to review the stochastics. We haven't done this in a long time. Stochastics are important because it gives you a good idea when to buy and sell stock. I update this every week, these charts. All I do is I take a chart from Yahoo Finance and draw a line at the top and a line at the bottom. And you can see we already went through this S&P. It's super maxed out, starting to go down. So I expect like the next week or so to be down. And then towards the end of the year, we're going to go up. Let's see the QQQ. You can see the QQQ in the last week. Just in the last week, it has gone from overbought. It's going almost at oversold right now. You can see that. But the stocks are actually at the top of that channel right now. So usually we have to wait for both to line up before it's time to buy that sector. So right now we're not oversold in any way there. Let's look at the aerospace. So, it's kind of going to go in sideways like this. Let's look at the gold, and it's going sideways. Consumer discretionary, it's overbought. And what I like to do is I like to look at all the different sectors and see where they are in general. Most of them are overbought, trending down. And this one is actually down the whole way. It is communication services. So that's like the phone companies, and maybe they throw in Facebook and Google, a couple other companies like that. But that's oversold. So it's that sector is oversold this week. And healthcare is overbought. And healthcare hasn't done anything this year. Look at this. It's been sideways. The whole industry of healthcare. Usually there's like 5 or 10% growth in that sector. And a lot of people are saying this is the sector it's going to go up next year because it's been basically not doing anything this year and underperforming. So you see. Let's look at the industrial. No, it's overbought. into the top of its range. This one is consumer staples. That's in a downtrend, and it's at the top of its range. So every one of these sectors is overbought right now. XL financials, top of its channel and overbought. Let's look at XLU. This is the utility sector. They pay a high dividend with interest rates for treasuries going up. There's less demand, but you can see there's a start of a breakout a little bit, potentially because if interest rates go down, this sector will be going up. So we might have a little uptrend starting here. If we have and it's totally dependent, I think, on the U.S. Treasury market right now. So let's see if this channel starts going up a little bit. But if you are a person interested in dividend stocks, this is the time to start dollar costing into those because they're being thrown out with the bathwater. Throw out the baby with the bathwater. So I'm starting to dollar cost just a little bit into high dividend stocks, and because they're low demand in a higher interest rate environment. Let's look at this one, XLRE, real estate. We know the interest rates might start going down in May or so. This sector will probably go up then. But right now it's in a sideways pattern. All right, so what do we have here? Energy sector, it's going down. It's the price of oil is $70 a barrel, the lowest of the year, so that's why this is going down. If there was a global recession, would have lower prices of oil and all the energy stocks go down with it, I think. So let me see. This is an example of a stock we started following right around here or so. Or maybe right around here. It paid a 15% dividend, and it was a way to diversify into a different country. So right now it's happened to be in an uptrend. It's paying like a 10% dividend now, but it's overbought and it's oversold almost right here. And it's oversold right in the middle. Okay, so it's neither time to buy or sell. Maybe another week it's truly oversold. And uranium. Dan Now said at the beginning of this year, this would be one of the best performing sectors, and it actually turns out to be a really good performer. This is just a ETF for the uranium companies. So I guess the theory with uranium is that people are going to be countries are going to be transferring into like energy. They're going to be transitioning into solar and different ways for helping the environment. And uranium is one way to have a clean energy infrastructure. And this will grow over time, he said. So let's watch this ETF. Okay, let's look at some of the stocks we're following. This AbbVie is kind of in a sideways. It's losing patent expiration. It's trying to buy companies. Another company they tried to buy this week. So they're trying to replenish their portfolio. Usually it takes a while for that to happen. So this is going to be sideways mostly for maybe another year. Abbott, it's in a sideways trending sideways. I think all the dividend-paying stocks are going to be sideways like this. Let's watch that. Alibaba. This is an example. We stopped, thinking about buying this like last year, and we're following it now. We're just seeing that there's more and more uncertainties around China companies, and I don't know. It just seems it seems like it was in a sideways pattern here. Now it's starting to go down out of that. This was one of Charlie Munger's favorite stocks for when he bought it for the Daily Journal, but I still can't see the value in it yet. So we're still following it just for kicks. Alphabet. Look at this. This is one of the stocks that is truly oversold in its stochastics. And it's at the bottom of its channel. It went up a lot this week for, they had a ChatGPT competitor, Gemini, and that turned out to be a pretty good demo. But right now they're at the bottom of their range, and a good time to start dollar costing into it if you're interested. Altria is in a super downtrend. and it's overbought, and I'm not sure where the stock is going. There's a trend away from smoking in America, and they had a problem where this company had to stop selling menthol cigarettes, which kind of is addictive. So if they stop selling that, that could be one of the problems for the company. People won't smoke as much. So we'll see what happens there. Amazon is still in an uptrend. Look at this. This is one of the best charts we're following right now. It's up like 60% this year or more. And they're still overbought, going down. And you see Apple is super overbought still. You can see this is one of the best charts that we're following. It's near the top of its range and overbought. It's not time to buy that one. AT&T, Mark's favorite stock. This one is in an uptrend. It's broken out of like a year downtrend, like right here, and it started going in an uptrend, and it's overbought and at the top of its range. So it's better to buy it when it's down here and when the stochastics are down. Bristol Myers. This is an example of a lot of the stocks that are high yielding that were thrown out with the bathwater, and like Verizon and Philip Morris, they're all in downtrends, but this one's starting to recover, and maybe the utilities start to follow that, and some of the other telecoms that have high dividends. Let's look at Bristol Myers. This is just an example of a stock it's not growing anymore. And if you look at their earnings estimates, I can't pull it up right now because the internet doesn't work. Come on, internet doesn't work. All right, but their earnings estimates are like flat for the next 5 years. So there's no growth. We're following it just because an example of a stock. You got to keep looking at those earnings estimates. If they start going down or flat, then you got to like bail out and go to another stock. This is an example of a stock that's lost its way in a way. So let's look at Colgate, the dividend stock. It's going in this trading range. It's at the top of the trading range going down, and it's better to buy it when it's here and the stochastics are down to here. Meta, it was in an uptrend all last year, and now it's in a sideways pattern. So it's basically not going to be going anywhere soon, probably until earnings. It's oversold. You can see it's oversold, and it's halfway between its buy channel. This is its channel, new channel it's in right now. So it could be a good time to start dollar costing into that if you're interested in that stock. JP Morgan, it's at the top of its channel, top of the stochastics. Not a good time to buy that one. It would be better whenever it goes down to here to buy that, and when the stochastics are down to here. Microsoft, this is one of the 3 or 4 super positive charts for the year. The intangible for Microsoft is they have this AI ChatGPT Copilot product that could revolutionize search and office productivity, etc. And that is generating all kind of excitement. And they're getting a premium. They're not really growing as much as they. The stock is going up a lot, but it's not because of earnings estimates. It's because of hype around AI, I think. But you can see it's near oversold, and it's halfway between its channel lines. So maybe another week or two, it'll get down to the bottom of its channel line, and it'll be time to buy again. And Pepsi is in a downtrend. I think this stock was hurt a little bit by the drug stocks that cured obesity. If people aren't obese anymore, they're not going to buy Frito-Lays or Pepsi. So I don't know if that's going to happen or not, but I'm not selling because of that reason. But this is example of a high dividend. They pay a dividend. And a lot of the stocks paying a dividend these days are not doing good because of the treasuries going up. So as the treasuries go down, I'm expecting this stock to recover and start to go up again in this uptrend. So Procter & Gamble, this is an example of a dividend stock. It's kind of stuck in this trading range. like every other dividend stock we're following. And Starbucks is also in a sideways pattern. We only do these stochastics charts maybe once a week, just once a month, just to go over examples of when to buy and when to sell a stock. Like right now, Verizon is an example of a stock that's high dividends. Now, as the interest rates go down, like the treasuries, it went down 6% last week. As that goes down, the value of these stocks go up. Because let's say in May of next year, interest rates will be at 3% on a 10-year. Then people will be wanting a 10% yield like you get at Verizon or Philip Morris or these other stocks. So it just started that uptrend because people are anticipating not having a 5% or 6% treasury rate in the future. So that's why I'm starting to dollar cost into some of these high dividend stocks right now and balance out my portfolio. You see, Visa. This is one of the strongest charts of all time that we're following. I mean, it has a consistent demand. They're growing. The thesis for Visa is they're a tool collector. As the economy grows in America, there's more transactions and take a portion of every transaction. They don't take any risk for credit card transactions. That's all the banks. And they're trying to get more people around the world to sign up for credit cards. So 90% of transactions around the world are still cash. So you have to, what they're doing is they're trying to go into different countries to get them to use their credit cards. And that's the thesis for this company for me. And I see that MasterCard has that same business model, and they have a similar growth rate. Okay, Waste Management. It is a dividend stock, and it is stuck in that dividend range. They're top of the range, and they're overbought, so it's not a time to buy that one. This is Amgen. It's a drug stock, and it's in an uptrend. You can see that they're overbought, and they're at the bottom of their range. So it's not a good time to buy that right now. CBS. This is an example of a stock that's been in a downtrend for like 2 years, and they're starting to break out just right now. I'm not sure what to make of that, but their financials aren't that great for their earnings estimates. So we'll just keep an eye on this as a stock not to buy, just to follow. They actually bought one of the biggest healthcare providers. So they're like a United Health, where they I think they bought Aetna. I'm not sure, but they're not only a health company, they're actually they have their stores too. So I don't know. They have a big problem where Mark Cuban set up a company that sells drugs at cost, a little bit more. And now they have to adapt their business model around that, and they might lose a certain amount of money for doing that. So this is an example. Warren Buffett would not buy this stock because their business model, you can't see 10 years down the road whether they have a viable business model, because it's in transition right now. Their whole thing where they charge for a farm, how they charge for filling prescriptions, it's all changing. And we don't know how it's going to work in 10 years. So because of all that, I'm staying away from it. It's a good stock to watch and see and see if it change, see how the business model evolves. But I'm not interested in it because it's not consistent. Okay, this is Johnson & Johnson. It's in a sideways, dividend paying kind of stock. It's has all kind of potential liabilities. This is another example of a stock I would avoid because they could go bankrupt because of the talcum powder lawsuits. We don't know, and we don't know what's going to happen. They could break up their company a couple of times, but other than that, it's really hard to value a stock that could go bankrupt. So I'm staying away from because of that. Walmart. This is an example of a stock that did really good during COVID, during the last year when people were switching from dollar stores to from target to something more reasonable. And that worked during our recession, not our recession, but during high inflation. But you can see we started the downtrend here. I don't know why. We're oversold, and we started to get out of this uptrend. So I'm not sure why we broke out of that, but it looks like we're starting a little downtrend right here. Why could that be? I don't know. I'll figure that out. Right now we're super.
That downtrend is also on volume.